Hello everyone. Yeah, I'm live. Okay. So we are going to read a presentation by Professor Sanjay Bakshi. We have introduction about Sanjay Bakshi here. Frankly speaking, I am hearing about him first time, but he has a good following on Twitter, so must be good. Let's have a quick look. So, as per him, we need to know the concepts, but we those concepts should be backed by the experience, the real world experience and real world problems. Then only you can make some mental models and work on them. So you have models, you have experience, some direct, some vicarious, and so then only you can work. If you only remember and work on what you remember, you will fail in life. But when you apply the concepts on real world problems, then then you go ahead. So let's see. So the key discipline one is mean reversion. What does it mean? It means in case some business is doing very good, but after a period of time, that business will slow down and stop giving good returns because there will be competition. There will be some companies in same area, same industry, or there will be some alternative industry that may give an alternative to the customers for that high profitable company. So when we have extraordinary market returns, then they are followed by poor returns. So in long term, the returns are generally average. That is, we combine the inflation rate plus growth rate. That's the best we can get out of any stock market in the long term. In short term, there will be exceptions. And the long term and short term, the definition itself depends on multiple things. So as a trader or as an investor, we should learn how to write the profitability part, how to write the monopoly parts before that industry or that area returns average. So when I say a company is high returns, then competitors will be driven by envy optimism. They'll rush in and they'll expand the capacity, and in the long term, the price will collapse unless there are other alternatives that may help the company or companies or that industry. For example, cartelization, like cement industry in India. Uh, let's say tech, know-how, patents, or some sort of political backing, or any other form of unfair advantage, high capex. There's some of the methods or some of the exceptions one can think of that may not work with this rule. So coming back here, so if your underlying business in the economy generates a 15% return on capital, the stock market cannot sustainably deliver a 30% annual return. So period of overperformance will be followed by period of underperformance. This is a feature, not a bug. In the long run, the market reflect what the businesses are doing. Second moment discipline is momentum. The opposite force to mean reversion, as taught in physics, and object in motion tends to stay in motion. A great business, if it gathers momentum, can become better and better over time. It is concept of fundamental momentum. They are able to define mean reversion and compound value for decades. So that's what we were speaking about earlier. So they can be characteristic of compounder, strong widening market competitive mode, sustainably high return on capital, ability to invest earnings at high rate, exceptional management and culture. The biggest error an investor can make is confusing a cyclical business for a true compounder. So what is cyclical business? Let's say metal industry is a cyclical business. So we have to think about those things. So what is distinction? Momentum framework focus on long-term growth potential. Premium for quality long holding period apply to true compounders. Focus on cycles by when out of favor, sell when hot, short holding period, and cyclical businesses. The scarcity principle. The key of lies in answering one question: who controls the scarcity? Not all shortages are same. The durability of a company's profitability depends on whether its unique scarcity can be easily replicated by others. For example, iron and steel company. Who controls the scarcity of steel? Anyone who with enough capital can build a steel plant. No single company has a monopoly on steel plant. The scarcity is temporary. That's a mean reverting business. The Ferrari company. Who controls the scarcity of a Ferrari? Only Ferrari. They meticulously manage production, that is 13,000 cars a year, and maintain brand exclusivity and pricing power. The scarcity is durable and controlled. That's business that exhibits momentum. But Ferrari is a luxury car company. There will be other luxury car companies. So for Ferrari to build the Ferrari brand, to become a Ferrari, takes a long, long time, takes a lot of hard work, takes a lot of thinking and marketing, a, a, a perfectly execution, so that a Ferrari can be a Ferrari. So similarly, like we have diamond, even a moat seems impenetrable penetrable can be breached. The story of DBS is a powerful lesson. A moat can change. So DBS, I think we have all read about how DBS used to control global supply of diamonds, creating an artificial scarcity. They famously coined a diamond is forever, cementing their control over the narrative and the market. The present, we have high quality, low cost lab grown diamonds that has fundamentally changed their control. The scarcity of diamond is no longer exclusively in their hands. The key lesson: always reevaluate the source of a company's competitive advantage. Is it as durable as initially thought? So, the big lessons of investing: there are dozens of ways to succeed. The path to wealth is filled with high uncertainty, and many an entrepreneurs who seem unlikely to succeed end up billionaires. It is all about getting exposure to positive outcomes. In contrast, there are only a few well-trodden paths to blowing up your capital. That is the realm of behavioral economics. Understanding the common psychological biases that cause people to screw up and avoiding them. My course in business analytics is about how to make money. My course on behavioral finance is about how not to screw up. The power of asymmetric bets. The fundamental magic of equity investing lies in the inherent asymmetry relationship between what you can lose and what you can gain. If you buy stock at 100 without leverage, maximum leverage 100 rupees, potential gain is unlimited. The principle is exaggerated in venture capital that seeks exponential multi-baggers, but it is the foundation of all equity investing. Different stages and the same game, the investing spectrum. Venture capital pre-IPO focus on market creation, hunt for exponential multi-baggers, bets on unproven founders and ideas. Power low dominates return. The Great Divide IPO shift in accountability. Focus moves to cash flow. Market to myth becomes marking to market. Quarterly earning pressure begins. Value investing post IPO. Six proven prosperous companies wait for the market to misprice them. Focus on existing modes and safety, less concerned with multi baggers and gaga. The Great Divide, a tale of two markets. Private market financing up rounds are common. Valuation climb with each new investor. Valuation information marking on myth, metrics like growth, users and narrative. Founders are told to delay monetization and focus on hyper growth to attract the next round. Post IPO financing double down on norm. Capital is raised at a discount to trading price. Valuation show me the money. Market demands real earning and cash flow. Incentive pressure for financing. Initial discipline, accountability, and managing short-term expectation. Founders dilemma: 0 to 10 crore at all cost. Monetization can wait. Narrative is everything, and then 110 to 100. Cash flow is king. Quarterly results matter. The numbers are everything. When you go what got you from 0 to 1 is not going to take you from 10 to 100. It's like driving a car at high speed. It's really have to turn around and go to another direction. The hallmark of great founders, good capital allocators. They understand resource allocation instinctively. They are frugal and avoid flashy offices, extravagant spending, and treating investors' money like as their own. Highly coachable. They are receptive to feedback and view investors as coaches, not as people who will build the business for them. They are open to changing their mind. Operationally disciplined. They focus on right metrics for the business model and diligent about tracking their numbers, providing transparency to stakeholders. Evaluating capital allocation in venture. Without profits to reinvest, how do you judge the founder's allocation skills? It becomes qualitative exercise to observing choices. Track, have they built something successful before even outside their current venture? What was the feedback? Frugality and focus. How fancy their office at city stage? Are they spending on essentials or vanities? Strategic bets. Do they experience experiments in product sales and marketing? Seems logical and focus on finding true product market fit. Flashy office and extravagant parks before proving models. Listening too much to growth at all cost. We see a lack of transparency with investors about key metrics. Founders test. When the world changes, founders funding dries up, a pandemic hit, a competitor emerges, a founder's true metal is tested. The most difficult decision is to pull the plug on the failing project to save the company. They are self-aware and pivot before the runway runs out. They are transparent with investors about challenges. They perform the necessary cancer surgery to ensure the whole company survives. The ultimate goal, whether to seed stage or public markets, is the same: to find an undervalued opportunity with the potential to generate significant returns. The multi-bagger myth in value investing. For venture capital, multi-bagger is a necessity. Since many companies go to zero, they need a few 60x winners to make up the losses and generate portfolio returns. So for public investing, the obsession with multi-baggers is less important. The primary focus is on the compound annual growth rate of the entire portfolio over a long period. What matters is steady tax efficient compounding of the portfolio, not hitting a few home runs. The three pillars of value investing: business like thinking, Mr. Market, and margin of safety. Underneath every stock, there's a real business. The analysis must be grounded in the economics of that business, not just a fluctuation of its price. The market is a maniac, depressive business partner. It can do crazy things in the short term, but in long goal is to exploit this its irrationality. That is what you have to think about. The goal is to exploit its irrationality, not be swayed by it. The cornerstone of value investing always insists on buying a security for a price significantly below your conservative estimate of its intrinsic value. I think I'll print out this thing and stick it around. I'll take a screenshot. Let me open a Word document. Okay. Misconception: growth plus value. One of the biggest misconceptions in finance is the creation of separate growth and value buckets. The reality, growth is simply a component of the value equation. All intelligent investing is value investing. What is stock worth? The wrong question. Modern finance obsesses over precise valuation model (DCF), which Professor Bakshi calls an exercise in delusional thinking. Given the uncertainty of the future, what is the exact value of the stock? Is the value likely to be much more than the price I'm paying? I'm being asked to pay. Ben Graham never tried to pinpoint an exact value. His goal was simply to confirm the minimum value was at least twice what he is paying. There's a sense of margin of safety. The evolved approach. बोलो. Hmm. क्या? I'm not hungry. नहा लो. तुम कर लो यूज उनको. हेडफोन अच्छे ना तुम्हारे पास. मैंने अपने ऑर्डर कर दिए अमेजन से. कल आ जाएंगे. 2,500 के. 2,500 के. अरे वीडियो चल रहा है भाई, सब सुन रहे हैं. कोई तो होगा ही जो सुन रहा होगा. स्ट्रीमिंग कर रहा हूँ यूट्यूब पे. आपको स्टॉप करना चाहिए ना. स्टॉप का ऑप्शन नहीं दिखा रहा ना इसमें कहीं पे. तो स्ट्रीम खत्म हो जाएगी ना, फिर पूरी तरह कर दो काम रहा है. इसका नाम हो गया. हाँ, ये कार्ड तो दोनों इसी में लगे हुए हैं. कार्ड रख दो यहाँ पे, देखते हैं मन लगेगा. सोच रहा हूँ कि स्क्वायर के बैट निकल जाना, ये जगह बन जाए अपने घर यहाँ पे. बात करके देखता हूँ उससे, आनंद से. एक बैट बेच दे कम से कम, ये वाला बैट बेच दे तो फिर जगह बन जाएगी यहाँ पे. ये वैसे बैट पैक हो जाएगा बैग, ये बैट में सब खुल जाएगा सारा बैट. अगर नहीं बेचता हो अरे वही डाल देंगे ना. बारिश का पानी कहाँ आता है वहाँ पे. बात करके देख लेंगे वो तो. उसके से डलवाएंगे ना, आने से डलवाएंगे इसको यार. Quality with the focus finding outstanding business with enduring competitive advantage and long growth runways, and instead of paying a price, it provides significant margin of safety, price that even a steep value provides would find reasonable. A concentrated long-term portfolio. The strategy makes founding where rare grades are seldom cheap. This naturally leads to more concentrated portfolio and longer holding, but waiting for this market to recognize the value. Okay, that is what we have to think about. Hmm. That's what we had IRFC at one point of time, and we have to find those stocks once more. ठीक है. Case study. About 2 years ago, for a senior opportunity Keros government on companies. The US is still they are not on the they are not on, so it must be bad. This is state normally in the strong balance sheets. Thank you very much.